Hello and welcome to this mid-year reset. Now, we thought this was going to be an opportune moment here at Scope Markets to really take account of exactly what's happening within financial markets. So many moving parts, but there's a feeling that we could be turning from one set of regime parameters into another. And the weekend announcement from the US and the EU plays into exactly that. So myself, Josh Mahony, Chief Market Analyst at Scope Markets, and Timothy here, Timothy Kiarie in the Kenyan office. We wanted to give you an overview of exactly how we see things. Sometimes we'll agree with each other, sometimes maybe not, and cover what to expect, what's happening right now, what we think would happen in the back end of the year, and how is that going to impact some of the main markets. So good to see you, Timothy. And yeah, I'm looking forward to sharing this hour ahead with you. Lots to get through.
Yeah, thank you so much. It's my pleasure to always have you in this session, even as we gear to look at the performance of the markets H1 and also looking at what's ahead in the H2.
Exactly. Like I said, we've got a huge amount of slides, so lots of useful information for you guys, but we're going to jump into it and kick off first and foremost with the idea around what exactly should we be looking out for. Now, this is just a small list because there's always a huge amount of things that can happen and can move markets. Sometimes as a trader, it's a case of looking out for an event and thinking, how is that going to move markets? Sometimes it's a case of trying to understand that within this time frame there's going to be a change, or there's likely to be a change, and that might mean from fears around recession into feeling positive about growth, or it could be from a central bank cutting interest rates to suddenly not cutting, or not cutting to cutting, and all of those different dynamics really shape financial markets and provide themes that can provide long-lasting moves. I mean, look, ultimately, we've seen massive sell-off in terms of US dollar. Is that going to continue? We've been seeing significant strength in terms of gold. Is that going to continue? Has the downside move in oil been overplayed? There's a huge amount of question marks within this. But just to sort of wrap up this sort of slide, for me, there's a number of them around the US. Of course, we've got the potential pivot from the central bank, but we've also got pivots in the opposite direction for those that have already led the way, be it the likes of the ECB or the Bank of Canada. You've got the fact that the US has a huge amount of treasuries being issued this year. So what's that going to do in terms of yields? Do yields rise once again? Does that give further credence to the idea that we're seeing a huge groundswell in terms of debt in the US, and that bolsters gold? That's a potential theme. We've got inflation, of course, and that's going to be something we're talking about here. Will inflation rear its head once again? The UK, in my part of the world, we've got the budget and a likely tax hike. So we're going to cover a bit of that. And then stimulus on the fiscal side of things. We've, of course, seen the likes of Donald Trump coming out with his big, beautiful bill. But part of these deals include a pledge to spend money in the US, but also you've got pledges to spend money on defense here in Europe. You've got the Chinese that potentially are going to stimulate further. So the fiscal side of things coming as well. So that, from a sort of top level, is for my opinion, some of the key things that I think are going to be moving markets in the first part. So in terms of tariffs, Timothy, how do you see things in terms of tariffs and how they're playing out at the moment, how they could move the markets in the future?
I think we have seen a lot of turmoil with the tariff, especially since April, the Liberation Day. And we have been able to see the major indices from a different jurisdiction losing a lot, but again, we have been able to see a bounce. But what really matters at this point, this hour, is the negotiations that are going around the tariff, which will again shape how the market's going to react. For instance, this morning we have the US and EU equities, which have opened with a strong, very bullish. Actually, we have seen the S&P 500, we have seen the Dow Jones, we have seen the Nasdaq 100 create a new all-time high today because of the EU deal. And therefore, what is significant is the negotiation. We are looking at this Friday being August 1st, the deadline. And it will be very crucial in terms of the deals, how the deal going to be sealed, how each and every country going to seal the deal. So that's very key and crucial for every investor.
Yeah, I mean, what's interesting here, like you said, is the EU's turn this time around. We've seen Japan before it. And with each one that we see across the line, it does provide the framework for the next to perhaps not embarrass themselves so much, right? So if you sign up for a deal that sees very elevated tariffs and pledge for spending, it's not really a great look as a leader. But if a number of countries have done that before you and you think, well, at least I'm as part of that pack, I think each one that comes across the line heightens the chance of another deal. Now, of course, the big one is China, and we do have a prolonged deadline for that. I think it's August the 12th. So, of course, there's a possibility that as we get closer to that, you have increased fears, but you have got hitting the news wires at the moment, the possibility of a 90-day reprieve. So clearly, I think there's a deal in the offing between the US and China. And I think a lot of that comes down to the rare earth minerals. Once the Chinese started restricting that, I think Trump started coming to the table. And I think there was much, much higher likeliness of an agreement. In terms of the reaction for markets, you can see here, this was the reaction in terms of Nikkei following the announcement. But, you can see the same thing here in terms of European markets today. There's an expectation that it's going to benefit the region in question. But you're talking about countries that are keeping tariffs on their companies, right? So this whole flood into different nations or different stock markets, be it, say, the likes of European stock markets, the DAX hitting record highs on a daily basis. And then now everyone celebrates the fact that we've got 15% tariffs. I think Trump's played his hand perfectly because ultimately, if you'd said from the get-go he was going to enact those tariffs, maybe markets wouldn't feel so happy. But because he threatened the 30%, suddenly everyone's happy about 15%.
Yeah, sure. And I think what is very important to note, I heard Trump over the weekend mentioning about there will be no extension at all. So I think now it's the end of the tackle that we have been witnessing with Donald Trump. This time he's very precise, very firm. But again, it's just a matter of waiting and seeing what's going to transpire.
Yeah, but the interesting one is, right, so as he knocks off the sort of main ones in this first pack, the taco apparently isn't happening this time. And then you hear about the possibility of pushing the Chinese one. So I think the Chinese might be the outliers and they might tackle on that one. But I think he knows that if he gets enough of them across the line ahead of this sort of 1st of August deadline, it will force some of the others to then make the move quickly anyway. And then the Chinese might be a different story and you take that on its own merits. So yeah, definitely that's going to be the sort of key one to be looking out for. Now, I think inflation is going to be a major story. Now, to an extent, I think maybe the ability to get over the hurdle that is the tariffs on the 1st of August and, the different deadlines prior to that, I think will mitigate some of the market reaction to inflationary data if it comes in heavy. But certainly it's not to say that 15% tariffs do not provide inflation. We don't know how much it provides. We don't know how much is going to be borne by the seller. We don't know how much is going to be borne by the importer. And we don't know how much will be borne by the US consumer. Of course, the worry is that it all gets passed on the consumer. Suddenly CPI and the like starts to spike. And then we see a longer period to wait for the Federal Reserve to cut rates. But that, I think, will be a continuing theme. It's just like I said, I think if we do see trade deals coming into the fore, then it might take the edge off the market reaction if we do see a spike in terms of inflation. Just looking at the comparison here in terms of who does what or who is where. Concerningly, it's the UK that's on the rise notably, but you have started to see the United States turn higher. And of course, with each trade deal that's struck, it seems that the other country doesn't put tariffs on the US, but the US puts tariffs on the other nations. So inflation, by and large, should be a US problem and not so much the other regions, apart from the fact that the UK is in its own situation where we've seen government policy forcing it up of late. This is a breakdown in terms of the monthly inflation. It points towards a similar kind of thing. So monthly CPI, if you put a sort of 6-month annualized, so the past 6 months, as if that's the rate for the entire year, you can see that actually the US is at the bottom of that. So inflation just hasn't reared its head quite yet in the US. There's a question mark on whether it's going to be a delayed process. And you can see that here, right? So the prices paid element within both the services and the manufacturing PMI readings if you provide a 6-month lag, and you can see that it tallies up in the past with that sort of lag, that points towards a possibility of a surge in terms of price pressures. Of course, what goes up can come down as well. So bearing in mind, if suddenly many of these fears around tariffs actually come down, then so that ISM prices paid figure would drop as well. But there is a question mark about whether many of these businesses have front-loaded tariffs. So they know tariffs are coming, they import all of the goods ahead of time, they stockpile it, they have huge inventories, and that means that it's not immediate that you see the impact of tariffs actually hitting the businesses, and therefore you would see the lag, as we see here, that potentially provides that resurgence in terms of inflation down the line. Whether that comes to the fore or not remains to be seen, but certainly that is a possibility, and we've started to see some signs of inflation. In the last inflation report, you might look at the number and say, oh, look, we're not seeing tariff-led inflation. But there's a few things in terms of imports where we did see a notable surge. And you can see that in terms of the average is essentially the diamond, and then the figure for the June 2025 numbers, where we can see things like video equipment, shirts, dresses, audio equipment, footwear, appliances, toys, sporting goods, furniture. So we're starting to see very tentative signs of inflation, but not quite yet. And I guess the question mark here is, will markets care when we see inflation, or are they just going to think, well, that inflation was built on a previous assumption that is no longer? But yeah, tariffs are still there, right? So what do you think? Do you think we're going to see further inflation, or do you think that this is going to be waved off by the markets because they don't really care and that the Fed will look through it?
I think one of the key things, or one of the narratives that is around the globe right now, is the dominant of the inflation. And we can say that part of it, or major of it, is basically caused by the tariffs. And therefore, because right now we are talking about around 2.1% global inflation, that is globally. What I'm looking forward is, if you're going to see a deal being struck, especially with the August during the August fast, therefore we're gonna see these maybe probably the inflation continue maybe to push on the downside. But right now, all we are seeing is some mixed trends, because you are seeing some regions we have low inflation, but still being very sticky. So what will determine maybe probably the next level that the inflation maybe probably could go in different jurisdiction is the tariff deals that is likely. We have the deadline, the August 1st. I think that one will cement a very key, or will be very crucial in terms of seeing where inflation is going. If you look at regions like maybe probably the US, we have been able to see the data that was released 2 weeks ago. Is it 2 weeks ago? We were able to see an increase in CPI up to 2.7%. And other jurisdiction as well, in UK, we are seeing some slight increase in inflation. So it will be very sensitive. It will be very key for every investor, for every trader, to monitor the CPI trends or the inflation trends closely, because again, these are the ones that will definitely influence the interest rates decision and also the risk sentiments in the markets.
Yeah, and another thing to note, right? So you have 15% tariff, let's say, on imports from the EU, but we've seen such a deterioration in terms of the value of the US dollar that this also increases the cost of imports coming into the US. So European Union companies aren't just selling to the US at 15% higher prices. They're selling to the US 15% plus the deterioration of the likes of the US dollar against their currency, which again makes it more difficult going forward. So I wouldn't be surprised to see inflation rearing its head. And in terms of the market reaction, look, it really will come down to how much they perceive this to impact the stance at the Federal Reserve. And for many within the Fed, it's a question mark of whether they just see it as a short-term phenomenon that they can look through because they now have certainty, or not. And my opinion throughout this whole process has been, if Donald Trump gave them certainty, even if that certainty is 15%, at least they have something to work with and they can see how the data comes out. If you have 15% and you're threatening 30% in a week's time, they're not going to cut rates, right? It's that uncertainty that stops the Fed. So I do think the Fed probably will be willing to cut rates against the backdrop of rising inflation if they know it's a one-off bump in terms of inflation. And if it's 15% plus the FX effect, but then some of it's been borne by businesses, and maybe it ends up being a 5% move onto the consumer, but it's short-term in nature. Maybe they just look through that. And it brings us to this topic of US exceptionalism, a sort of story that had really been building at the turn of the presidency, where we saw Donald Trump come in. He essentially announced a raft of massive tariffs. Suddenly it was like he doesn't care about his allies. Here in Europe, we thought we were friends, right? I think the Canadians thought the same. And he didn't seem to care about any of that. But ultimately, he's brought them back to the table. And now suddenly it's like, oh, we've got 600 billion being invested, 750 billion being invested. So that points towards two countries or regions that are very close together. So one of the things that I think will be really interesting for traders going forward will be this question mark of whether that US exceptionalism story comes back into play or not. And with each trade deal, I think maybe that sort of rebuilds the US exceptionalism story. This sort of highlights exactly what US exceptionalism is, and it means that the US stock market is different from the rest, right? And it has outperformed global markets historically, down to a number of reasons. But it's the most developed sort of financial market in the world. But then you've also got the biggest companies in the world. You've got the biggest sort of growth names out there. All the big tech names are there, and TikTok's not, but it may be soon enough. So okay, we can jump into some sort of German defense stocks for a period of time, or go into a UK bank thinking there's value in there, and low price to earnings ratios, blah blah blah. But like, if you're looking for the big growth names and where all the liquidity is and everyone around the world's investing into, it always comes back to the US. So do you think that we're going to see the sort of more widespread treatment of markets continue, or do you think that we're going to see money sort of flown back into the US and it becomes a very US centric environment if we see these trade deals all sort of pushed across the line?
I think we're gonna see quite. For me, I'm looking at mixed reactions, because already we started seeing people diversifying. That is majorly looking at other markets like the EU markets, and also the emerging markets, which are looking very potential. And therefore, we have also seen the S&P 500, which its resilience, which has been really underpinned by the mega tech and consumer strength. And also looking at the dollar strength, we have been able to see a lot of dollar weakness reflected by the policy divergency and also the risk of flows. Again, also looking at the trade wars disruption, the historical correlation, which again makes brings the idea of portfolio diversification. And therefore, for me, I'm looking at a stance whereby maybe probably different factors to support US exceptionalism. We might see maybe probably that exceptionalism continue to fade because now people because of different conditions, like for instance, strong domestic demand and offshore exports and losses. Again, we are looking at supply chain disruptions. We are also looking at maybe probably the capital inflows that are seeming to be strong. All right. So different factors we are looking at different factors trying to underpin these particular the US exertionalism. If you look at maybe probably what I was trying to talk about, we are seeing a resurgence of the meme stock mania. That means people are diversifying. We are no longer looking at the investors are no longer looking at maybe probably only the US stocks, so diversifying to other markets, emerging markets, China, India, etc., etc. So for me, it's going to be a bit. I'm not seeing the exceptionalism continue to thrive.
Interesting one. I mean, look, part of it will come down to whether we see sort of big tech easing off. It's certainly been leading the way thus far. And of course, with Donald Trump's policies apparently being about bringing jobs back to the US, there's a question mark about whether bringing jobs back to the US is really the same as doing right by US companies, right? So some of these deals will see investments into the US, but then if US businesses are going to have to relocate operations and suddenly they have smaller margins, that's not necessarily great for them. And earnings season will be key as we go through each quarter to gauge exactly how these new conditions are benefiting or not those businesses. But certainly, if we're looking at the sort of trajectory of like European stocks and things like that, a lot of it also comes down to Trump having pushed them into a position where they have to spend more. So like NATO spending, is expected to go through the roof now because they're being pressurized, and higher defense spending, higher infrastructure spending in Europe means that people feel a bit more confident about investing in Europe where they perhaps hadn't previously. So again, maybe that gives us additional returns from that side of things. Like you've said, we've seen this sort of meme stock move recently. I guess this is sort of indicative of how people are feeling right now. In terms of the sort of US exceptionalism story, I guess part of that is this idea around the US dollar, and Donald Trump certainly when he came here and said, he doesn't want people to move away from the sort of dollarization of the world and as the reserve currency, blah, blah, blah. But ultimately, we've seen the US dollar absolutely slammed. And in actual fact, it was only this week that Donald Trump's come out and said, well, it is actually good for us to keep our dollar low. So he has admitted that. I think essentially what Trump wants is to keep the US dollar being used around the world. He just doesn't want it to be particularly strong in the same way that it has. If you look at this trajectory of the US dollar since he's come into power this time, and you overlay it over where we were in the sort of 2016 election and when he came into power in the first time, there's this move out of the US dollar as he essentially breaks relationships. And then soon enough, the dollar comes back into play as he sort of rebuilds relationships. Are we going to enter this period of sort of consolidation with these trade talks and a potential resurgence in terms of the US dollar? Potentially, I think that's going to be a key theme, really. Like, what's driving this dollar sell-off? Is it associated with this idea that suddenly the US has become this pariah and no one wants to do business with them? No one's investing in their treasuries. Everyone's going off to invest in things like gold or other assets, other stock markets. And does that reverse once we see the likes of the US striking trade deals across the world? I think that's going to be a really interesting story. One of the things that I've noted since we saw the Liberation Day, and essentially markets thought, the US relationship with the world is over, is that we saw this correlation that had the differential between yields, so essentially bond yields tied up to the value of the US dollar. That's the normal way of looking at it. And instead, what we saw is higher yields and a weaker US dollar. So that is not a great position to be in. And that might actually reverse once we get these trade deals and once people start to become less fearful around the US relationships with its trading partners. So I think that's going to be a really interesting one to watch out for if we see treasury yields moving towards the downside.
I think also in terms of, before we go to the next slide, maybe in case a situation whereby we see the US exceptionalism continue, or maybe a comeback, I think this will be more selective, according to me, and very uneven, because we'll be looking at now sector specific, like maybe the AI, defense, energy sector, infrastructure sector, which are likely probably to shine. So I'm looking at a broader exceptionalism across all industries, which will be harder again to sustain. So it will vary on how things are going to unfold, because yes, we can have a comeback, but still it might be very difficult to sustain, or it will be very hard to sustain it across all industries.
Yeah, I mean, it's a great point. I think, if you look at it, certain parts of the US will do great either way, right? The tech stocks go higher either way. They're kind of tied to market sentiment, but, it's by and large for most of them, it's a service-led story. I think what will be interesting is, for all of this talk of, trade deals and big investment packages and, you name it, the fact of the matter is that US businesses are facing a bump in terms of costs for their inputs that businesses around the world aren't necessarily. And of course, those businesses have tariffs to sell into the US, so they also have a hurdle from that perspective. But those businesses in the US have to pay tariffs on things coming imported and then sending out to the rest of the world. So those exports might not necessarily be as competitive as they are in their home market. So I think that's going to be a really interesting one, and only something that we're going to see as sort of earnings season plays out. So the next topic we wanted to cover is about Jay Powell and the Fed. Of course, Donald Trump's been doing his best to sort of elbow Powell out, or at least try and make him cut rates. It doesn't seem to be working very well, and ultimately he's out the door in May anyway. And so the question mark here is, does he push him out before that? Does Powell leave of his own accord? Does it make a difference? Are we going to see the same amount of cuts whether he's in power or not? There's a lot of questions ultimately, and of course this week we've got the FOMC, which means it's a particularly interesting topic to be covering. Like you can see here, the ECB continuing to cut rates, the Federal Reserve not, and that's something that Trump has reminded us of time and time again. So Jay Powell, does he stay in the job for his full term? Does he make up with Donald Trump in the end and start cutting rates in September? How do you see this playing out?
I think that's a good question. And for me, why I find the irony is because it is the same Donald Trump that appointed Jerome Powell. And now we try to see, we are trying to see him fight him again, the man that he himself appointed. But what I can say is that I think Powell has remained more restrained. Because we have seen the ECB, as you can see from the chart here, they have been very reluctant in terms of cutting the rates compared to the likes of the ECB. And we have seen a lot of political undercurrents, and we have been having speculation about its job security. But for me, I will say that I don't see Donald Trump firing Jerome until his expiration term in next year, 2026. Even though I was, I think, was it last weekend that I saw Trump in a meeting, and he was trying to show a letter that already has been drafted to fire Powell. But I think there is a lot of chickening out for him to take that bold step to fire Powell. So I think he still has the job because, again, I want to believe that at the back of my mind that even Trump knows that the tariff, we are seeing the implication of the tariffs, and therefore it's just a way of trying to justify himself. Maybe probably try to push some threats to the Fed chair, maybe to cut the rates. But we have seen Jerome again is a man by himself, standing by what goes around, because he said what is going to really make the decision for the rate to be cut is being driven by the data. And if you look at the data, then it doesn't support a rate cut. And the reason why even this Wednesday we are anticipating the rate to remain the same at 4.5%. So I'll be very curious to hear Trump's speech after now the Fed decision on Wednesday.
Yeah, I mean, look, I agree. I don't think he forces him out. The whole thing about here's my letter to sack him, is a load of bluster. He doesn't have the ability to do that. Then we start talking about this whole thing about the renovations of the Federal Reserve building, and is there a massive overspend, and is that sort of financial misappropriation of funds, and is lying under oath, all of that. Right. But what happened before, where we saw the White House sources saying, oh, he's about to fire Powell, you then see the market sell off. We saw bond yields on the rise. We saw the US dollar selling off. So it was a way for them to see the market reaction of it happening without actually doing it. And the markets didn't react particularly well. Of course, it was only a small snippet, because soon enough he came out and said it's not true, and it all reversed. But certainly I think, look, we've got the Fed this week, right? So in terms of market expectations, there pretty much isn't any expectation for a rate cut this time around. But there is an expectation for a rate cut next time around, which is in September. And so if we see the Federal Reserve outlining that they are open to potentially cutting rates in September, which is what markets are currently pricing another rate cut by year end. If the Federal Reserve go along those lines, what is the point in trying, are you trying to force out Powell to get someone in to cut rates in September and one more time at the end of the year, right? You're not going to get much more out of the next person. And something I thought was really interesting was this from Deutsche Bank, right? Which shows you essentially, if you force Powell out, right, what's the benefit? You might get additional rate cuts over the near term. And so if you cut now, if you cut 3 times before the end of the year rather than 2, you will drive down borrowing costs on the near-term debt, right? So you're looking at like bills, 2 years, 3 years. So you'd see significant savings on that side of things, which is what Donald Trump's been saying, right? We could be saving trillions by cutting rates right now, drop it by 1% and the like, right? But if you look further out, the likes of the 20-year, 10-year, 20, 30-year, it moves in the opposite direction. Yields could rise because of the perceived instability associated with the US sacking the chair of the Federal Reserve, right? It's not the kind of thing that you see for most developing economies, and therefore markets would likely react negatively. So net, you don't get the same kind of savings. You know, Donald Trump plays up the savings he'd have, as you can see here, on the short duration treasuries. But the flip side might be that the long duration issuance then adds on cost because yields rise on the back end of the curve. And therefore, the benefit isn't necessarily as much as they had predicted. Wouldn't necessarily think that Donald Trump would know that, but certainly maybe the likes of Scott Bessent or someone within his team might say the benefit isn't necessarily going to be as good as you think it would be. And if they cut rates in September and another time before year end, that's not necessarily bad, set against a backdrop of the big beautiful bill where they're going to be spending more, taxing less. You know, I think it's all sort of coming together. And I think from a market perspective, the best thing is hold off, have these trade deals. Inflation might rise a little bit if the Federal Reserve are then able to say, look, we can look through that inflation and cut irrespective of that near-term rise, because we now have clarity on exactly what those tariffs are looking like, and they're set in stone. They're not suddenly going to jump up to 50%. Then that, I think, is going to be the much better way to do it. And I think by and large markets would take that as a positive. Should we move on to the sort of earnings side of things? So we've kicked off earnings season. We've had a few weeks of it now. And I guess one of the big narratives is always going to be Mag 7 names or big tech versus the rest, right? So this is a chart that I sort of bring up every now and again to show you the expectation that growth rates for big tech or the Mag 7 will essentially ease off on a quarter by quarter basis. That's the expectation. We're in Q2 2025, as you can see here, just in the middle. So we've been seeing easing growth in terms of earnings growth, but then it sort of plateaus around that sort of 10% mark, and notably starts to pick up for other businesses within the US. So I think that's an interesting narrative, right? So is it going to be the case that we see growth rates for big tech ease and growth rates for the rest of the market rise, and therefore the valuations associated with big tech shouldn't necessarily be at the same kind of levels that they are relative to the rest of the market? Or maybe they stay where they are and the rest of the market we see higher valuations. It's going to be an interesting one. Do you think that we're going to see sort of big tech falling out of fashion, so to speak, a bit, and we see a broader based rally in terms of US equities if these trade deals come into fruition and the Federal Reserve can cut rates and you name it?
I think what I'm looking forward to is, the earnings report that is kicking in right now is the Q2 earnings report. And we know how the Q2 was. It was a bit turbulence in terms of the tariffs. We have been able to see not really good results from some of the companies. Like, for instance, AT&T companies have reported bad earnings. Tesla too has reported a decline in terms of their earnings. So I anticipate to see, even as these earnings come out, even though maybe probably there'll be even though there are companies that are going to perform well, but again, I anticipate to see the effect of the tariff in these particular earnings. And the reason why I'm not anticipating much of the Magnificent Seven in terms of posting really nice results, even though I'm not disputing the fact that some of these are in the tech. Most of them, actually, the Magnificent Seven, they're in the tech companies. And as you can see here from this graph, we see a trajectory whereby we are seeing a like of a decline. And the reason why I began by mentioning that now people are shifting from the common known stocks like the Magnificent Seven now to other stocks. So I don't really expect to see much of that. For the indices, maybe probably we expect to see some bit of reactions there, because if you look at maybe probably the S&P 500, this week alone we are expecting about 163 or 164 companies and S&P 500 which are going to release their earnings. Meta being among them, Amazon, Apple, Microsoft, and yeah. So I think, in a nutshell, we won't see much as we have used to see in terms of the performance of the Magnificent Seven. Even though, again, looking at it from the revelation, since the revelation day, we saw they were very much in red, but right now they have been able to regain whatever the losses they made. But again, I'm looking at a steady performance for the Magnificent Seven.
Yeah, I mean, look, ultimately the two big Mag 7 names that have reported thus far, like you said, Tesla, not great, but they've got so many headwinds, it's ridiculous. You know, of course, the EV credits coming away, that relationship with China and the like, and more. But then you've got Alphabet. Alphabet came out with very strong CapEx numbers, and the TSMC numbers, who's the biggest chip manufacturer in the world, who manufacture chips for NVIDIA and the like, they came out with blowout numbers. So there is a story about potential continued strength in terms of spending for many of these big tech names, but it's very difficult, you know, like over time, these companies that have grown at such a fast clip, at some point they can't continue to grow at that kind of pace. But you are talking about companies that have done it for a long time, and the AI trade, who knows where it goes, right? I know that, you know, we all use ChatGPT and DeepSeek and other AI tools, but does it feel like it's reached its conclusion? No, not in any way. And these companies have put so much money into it. Of course, investors are thinking, you know, when am I going to get my payback? Yeah, we'll see some of that. But ultimately, down the line, where you possibly have a handful of companies that are dominating everything in the AI space because they spent all this money from the get-go and invested so much, you know, I think that they'll continue to be strong names. But like you've said, you know, we have seen, you were saying AT&T, you know, we saw General Motors coming out and saying that they're losing $1 billion because of the effects of the tariffs. That for this earnings season will be a key narrative, no doubt. Like, what's the impact of these tariffs on these businesses? And it's going to provide people with an idea of who the winners and the losers are in all of this, despite what Donald Trump's saying and despite how good these trade deals sound. Businesses will struggle with the imposition of really significant tariffs on other companies. And remember, that deadline kept getting pushed. So we never really saw these countries all being hit with 30%, 40% and things like that. So 15%, yeah, that's something that still will make an impact. And so that sort of redistribution towards the rest of the market, or like so the equal weight S&P, things like that, might come towards the back end of the year. In terms of, this is a chart that I found really interesting when Trump came into power again. I thought I'd bring it up again just to give you a sort of an idea from a sector basis, exactly who did well the first time around out of Donald Trump. This is the first 3 years of Donald Trump's back in 2016 onwards. You can see here, I would say the standout performers really financials, with the red bar, of course, tech with the light blue bar as well. But you know, you can peruse this at your own will, but some of these sectors have done particularly well. Whether it's the same this time around remains to be seen. Certainly it feels a bit different this time around, but it wasn't that long ago that Donald Trump was saying, I'm all about the Main Street rather than Wall Street. Well, you know, I think big banks have been doing pretty well out of this, and they've kind of had an advantageous position where it's like rates are elevated, so they get good margins, but the economy's been holding up well. This is performance year to date, so you can see just how some of this rally has been sort of spread or not. Certainly big gains for some of those big tech companies, but you can see industrials doing very well, financials, certainly JP Morgan doing very well in all of this. The defensive stocks not massively, Tesla not having a great time, Apple not having a great time. So the Mag 7 has this year been the sort of magnificent 5 and the not so magnificent 2. So quite whether that starts to shift, that narrative remains to be seen. I don't want to dwell too much on these, but I thought it might be a little bit interesting to sort of take you through some of the different sectors. So my thinking is this, right? So when you're looking at when you're looking at a market, let's say the S&P 500, and you see it hit record highs, you might think to yourself, okay, the US stock market's doing great. And that is the stock market as a whole. But there's certain things that lead it. You might say it's tech driven, and you would generally see that by looking at, say, is the NASDAQ massively outperforming the S&P 500? If it is, it probably means it's tech led, right? But there's different sectors. And certainly if you're an equity investor, you might want to look into this kind of thing as well, right? So what's doing well, what's doing poorly? Not all of them are doing well, right? Not every sector's doing well. And different sectors will do well in certain circumstances and not so well in other circumstances, like elevated inflation or lower rates are required for this area and like. So I just wanted to quickly breeze you guys through the outlook and performance thus far for some of the different sectors. So communications services and technology kind of go hand in hand. A lot of the com names are essentially tech stocks, and of course big tech and the like. Big tech's been leading the way, and you can see just how far it's run off of the prior highs that you had on that chart. But we've also seen a breach for communication services. Essentially these sectors generally lead the way when we see money flooding into the market, and that kind of has been the case. Then we've got industrials and financials. Industrials, I think, are going to be a really interesting one, just because there's been such a focus on getting huge funding coming into the country in terms of spending, in terms of countries abroad funding the US businesses, and money coming into like so Boeing and things like that. So industrials been doing very well because there is a perceived focus of Donald Trump and alike on manufacturing and bringing manufacturing back into the US. Financials have been doing very well. That is tied up to pro-growth. So if we see strong growth at the back end of the year, that's good. But if we see sharp rate cuts, it might not necessarily be ideal because it doesn't necessarily do well for their margins, but interesting areas to look out for. Energy and basic materials, again, these are really interesting areas. Essentially, energy's been doing poorly. There's a perception they will benefit from tax cuts, and now you've just seen from the deal with the EU, you've got LNG purchases. I think it's 600 billion being set aside, actually 750 being set aside for LNG purchases. So the demand's there, but what's going to happen in terms of prices? And certainly I think oil prices will be really interesting, if we see a perceived pickup in terms of global growth. Basic materials also a similar kind of thing, right? If you see global growth doing well at the back end of the year, and we see tariff deals, will we see materials start to pick up significantly? Then consumer cyclicals. So cyclicals, of course, the kind of thing that you buy more of when the economy is doing well, you buy less of when the economy is doing poorly. I'm not going to go out and buy a Louis Vuitton bag if I'm about to lose my job. Maybe that's just me, right? So these companies would do well in good environments. And the question mark for them would be, many of them are importing from abroad on the cheap and selling at very high margins. So that's the kind of area that we focus on. As you can see here, hasn't managed to break through its prior high. But if we see pro-growth at the back end of the year, sort of perception of pro-growth, and then you have these businesses hopefully going through earnings season and showing that they can deal with these tariffs, then it's an area to potentially look out for. Real estate, of course, has been struggling, elevated interest rates. But again, like we said, the back end of the year might be a time where we see a focus on being able to cut rates at a faster clip. And so maybe real estate starts to catch up. So that's me.
Maybe to mention something about the sector outlook. I think to me, what really stood out, like you just mentioned, we have seen a very good performance for the industrial, the technology and the communication sector, the financials. Some of the key sectors that we have really seen a lot of lagging or underperforming. We can talk of the consumer discretionary, the healthcare, materials, and real estate, which have not really performed very well. But again, I'm looking at a scenario whereby maybe what next now, or what are we anticipating maybe probably. And some of the sectors maybe probably that can be in the lookout. Still, we can talk about the technology and communication sector, whereby we are anticipating to see persistent growth, and the aerospace or the defense, which is under the industrials, whereby we expect to see remain leadership in the sectors, geopolitical tensions stay elevated, and also the AI infrastructure grows. So those are also the other one that is really important is to look at the small caps as well and the cyclicals, because if we see the fading of, the recent fading interest of these small cap and cyclicals, though we have been seeing a very clear technical signals, like maybe probably the golden cross on the Russell 2000, which might suggest maybe possible near-term potential. And again, still high rates and the trade risk may weigh on their performance. So the small caps and cyclicals is something that maybe probably investors and traders maybe can have a closer look at, because it's gonna provide it might provide some maybe probably best opportunities.
Yeah. I mean, the small caps point is a great one. You know, Russell 2000 certainly has a chance of starting to lead once again. There's a perception that with high interest rates they do very poorly, because many of them aren't profitable, right? So they rely on borrowing. But if you see a strong economy ahead and you see rate cuts ahead, you know, could we see the Russell 2000 breaking out? At the end of all of this, we're going to jump into some charts and try and breeze you through as many as possible to show you potential opportunities on that front. So make sure to watch until the end. We'll definitely make sure to look out for the Russell 2000 as well. One theme that I just wanted to pick up on, particularly in my part of the world, is the UK economy, not necessarily in a great position at the moment. And so I just think it's going to be an interesting theme going forward. Borrowing costs elevated. This is a story for many, but as we can see here, this is the spread of the UK bonds versus German, right? You can see the rest of the European region all on the decline, in part down to the actions of the ECB. UK borrowing costs elevated, and that is a problem for the UK. So the higher that the borrowing costs go, the more problematic it is for the Treasury, and they have a £20 billion hole that needs patching up when it comes to the autumn statement, which is either the back end of October or beginning of November. Coming off the back of 2 consecutive months of negative growth for the UK, the assumptions under which the budget has been set build on a certain prediction for growth. If the growth doesn't come in, then they don't necessarily get the tax receipts, and that's exactly what has happened. So we've got this hole that needs fixing. So that means higher taxes, and not necessarily a great outlook for the UK. Of course, there is an idea that maybe we could see the Bank of England step in and save the day if it's not the government that's going to do it, because they're just trying to fix a hole, let alone spending more money. So you're not going to get fiscal stimulus. And are you going to get something from the Bank of England? Well, we've been seeing inflation on the rise, and here is the highest level of inflation of all G7 nations. So elevated inflation ties the hands of the Bank of England. A black hole in the public finances ties the hands of the government when it comes to spending. And all in all, the UK is in a difficult position. Now, when it comes to the likes of the pound, you know, does the pound just reflect the weakness of this story? Not necessarily. And I think there will be a desire to cut rates if it's possible. But the way that inflation's gone at the moment, it's probably not something that is going to be too easy from the Bank of England. They will cut rates if they can. And so that's why I just wanted to sort of note, you know, keep an eye out for UK inflation, because if we start to see it turn downwards in a meaningful manner, it could start to force the hand of the Bank of England, because the UK is not necessarily in great shape. So to wrap up this whole thing, we just wanted to talk about commodities, because when we were talking about the sort of key areas that we thought were really interesting, a lot of it sort of focused around commodities. So we can talk a bit about commodities and a bit about some other charts, look at some indices and FX and things like that, and just wrap things up from that perspective. So let's talk about gold. Timothy, what do you think? You're a big gold bug. You feeling confident, feeling good after all of this time of strength, or you think we could fade?
Yeah, gold is quite one amazing asset, because I'm looking at it in different ways. We have been able to see during the tariff gold really push up, being a safe haven as people regard it. We have been able to see all-time highs for gold. And I think,
and you can see here that the fact is that it's going hand in hand with the dollar weakness story, right, as well. So that sort of plays into it as well.
Yeah. So I think the main question, maybe probably investors might ask or are asking themselves, is that is gold still the go to haven with inflation wrangling, and that can be looked from different angles, because as we know, gold prices are affected not only by the tariffs, but we have so many things that affect gold prices, and therefore, to me, I think we will maybe probably still continue to see more higher prices for gold. Again, even though it is pegged by maybe probably the interest rates as well, but we have seen these central banks also create an increased demand for the safe havens. All right, we have been able to see quite some increased demand in terms of gold reserve for the central banks. So what I'll be looking at is maybe probably the trade risks, or some factors to consider is maybe the trade risk and haven demand. So whereby maybe probably where we have in case we see the haven demand softens, which we might see maybe probably lower prices for gold, or lower prices for gold, because there'll be less appeal. In terms of tariff driven, we might be able to see, in case the tariff driven hedging declines, we might be able to see less speculative buying of gold prices, right? But like I said, the key question is, are we really likely to see gold still outperform? Because that is what is lingering on after the August 1st. Once we have maybe probably the deal seals in terms of those countries that are going maybe to negotiate. What I will say is that gold performance doesn't really rely solely on the geopolitical risk. There are other factors, like maybe probably the real yields. So gold, you know that gold moves inversely with the real interest rates. So if central banks maintain the dovish stance, or maybe probably inflation persists, while the rates drop, then it means that the real yields could fall, and which could lead to bullish prices for gold. If you look at it in terms of the dollar trends, the USD dollar, the US dollar trend, a weaker dollar basically tends to support gold prices. And what we are seeing right now, we are seeing a more weaker dollar, right? If you look at it in terms of the monetary policy and rate cuts, if the central bank begin to cut the rates to support growth, then gold could benefit as yield continue to fall. To sum it up, I think gold still remains quite attractive, and if the trade tension is and the tariffs, maybe the tariff-related flows dry up, then gold may lose one of its recent catalysts. However, it's good to understand that its performance is dependent on many other factors. Like I said, the real yields, the USD, the central bank policy, the inflation trends, and therefore gold may not. While gold may not really outperform, I'm looking at a scenario whereby it could remain resilient, or even climb if rates cuts and inflation uncertainty continue to persist. So for me, it's one of I think it's in my heart. That's one of the assets that I really look at keenly, and yeah.
I think if you look at the way we've seen sort of periods where rate cuts suddenly get priced in a meaningful manner, which is kind of what I've put together on this chart, right? So this is sort of the perception of where rates will be by year end. But essentially what we see is during periods where markets suddenly expect to see a raft of rate cuts from the Federal Reserve, suddenly gold starts to take off once again. And bearing in mind, we've just been through a period where there's a lot of like, what's going to happen in terms of inflation? It's tying the hands of the Fed. So suddenly we're not in a position where we're super confident that we're going to see a load of rate cuts. When we do get into that period, I think that could light a fuse under gold once again and provide that renewed reason to suddenly be very bullish gold again. But like you said, that the concern at the moment is like there's huge stockpiling from central banks. There's huge stockpiling from countries that previously had been investing in US treasuries, but instead now reallocate towards the likes of gold as their haven play. Does that change now that we see the trade deals? We don't necessarily know, and the data will play out over time. But certainly there's a possibility that with these trade deals and the easing tensions, it takes away one of the reasons to be bullish. So maybe if we see equity markets boom, and we see trade deals easing tariff fears, maybe it does provide a bit more downside over the near term. But I do think that back end of the year, when we really start to see the Federal Reserve potentially sort of getting going in a meaningful manner, then that could provide the basis for outperformance for gold. Now, gold has done particularly well. You can see here that the rest of the sort of commodity sphere hasn't necessarily done that well. And part of it is because commodities, by their nature, a lot of them, okay, you've got precious metals, but then you've got metals that are tied up to global economics, right? The perception of how the global economy is doing. How's China doing? Are they still building cities out of nowhere, right? Is Australian exports doing particularly well, or is the world sort of slowing down? And the tariff fears have really driven a lot of that downside, a lot of that concern, whether it comes to iron ore or copper and things like that, right? And so if we get into a phase where all of the trade deals are struck and now we're feeling positive about growth, is this a buying opportunity for commodities? Is there a so-called commodity super cycle around the corner? And, I've seen that phrase used a million times before, and it sort of gets you a bit excited just because it sounds like we're suddenly going to see a massive boom. But certainly we have started to see some of these markets doing well, starting to pick up. The platinum palladium story, I think, is really interesting as well, because of the fact that you've got a move away from this whole desire for sort of green energy, and everyone's got to be driving electric vehicles. The EV credits have gone out the window. And so the whole catalytic converter demand story starts to pick up once again. I'm going to just jump onto the charts. I know we don't have that much time left, but I'm sure we can look at some charts and try and see exactly how things are shaping up. So first of all, I just wanted to bring up that sort of platinum palladium story. So we've seen here in terms of a breakout for platinum. This is palladium on the monthly time frame. So are we going to see a similar kind of trajectory coming into play for palladium as platinum? Remember, platinum and palladium are kind of interchangeable when it comes to their use in catalytic converters. So you can see here that the sort of downtrend playing out, and then we've seen that sort of rocketing higher for platinum. Are we going to see a similar kind of thing? That looks a lot like a kind of basing pattern here for palladium. And like I said, with the EV credits going out the window, potentially the whole catalytic converter demand story start to pick up pace. So that for me is a really interesting chart to be looking out for at the moment. Gold, like we were talking about, it's done well. It's done incredibly well. Now we're in this realm where we're in this sort of consolidation phase, right? And, I've been tracking this on a sort of fib basis. We've got sort of trend line support coming into play. We're now breaking through it. As we noted, there's a possibility that maybe we start to see, maybe just see more of this, right? So with trade deals being reached, do we see question marks about the whole haven demand, blah, 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 right? So that I think is going to be really interesting. Do we see the breakout now, or do we move into the back end of the year? We see more of this chop. We wait until things clear up, and then we see the Federal Reserve start to drop rates in a meaningful manner, and then it outperforms. Maybe, I don't know. Do you think we're going to sort of start to push higher right now? You think we're going to consolidate for a bit in gold? How do you think this is going to shake out?
I think right now we might probably see some bit of consolidation. For me, I'm looking at maybe an instance whereby prices are likely to push to about just trying to pull my charts here. Prices are likely to pull down to about 32, around 3,300. That's where I'm looking at where we got the support, and also looking at the Fibonacci retracement and extension levels. So, but in case we see a break below the 3,300, then it means we might see some more lower prices. But again, this doesn't diminish the aspect that we might be able to see maybe more higher prices, because again, if you look at any time or when we have these economic uncertainties, even the institution traders, they run to gold as a safe haven. So for me, it's just a matter of buying the dips, and again, positioning yourself according, not just buying because it's the dip. Of course, you have to look at several factors: what's happening around with the Fed, the geopolitical tensions, and all those factors, and also aligning again with the technicals.
Yeah, I mean, look, when you're looking at sort of themes and narratives that are driving different markets, like I said, that back there with platinum, palladium, is the EV credit thing suddenly going to mean that there's demand for catalytic converters? You're always trying to find narratives. One narrative that's not going away is the fact that debt continues to rise in the US and abroad, but in the US in particular. Soaring debt doesn't make you feel particularly confident about putting your money into US treasuries as a haven, and gold doesn't have that same problem. You might have people start to try and dig for more of it when prices go up, but you don't get the same kind of possibility to sort of water down the currency through QE and things like that that you can get with central banks when a government's in trouble. Another area that's definitely worth touching on here is oil, because oil, of course, has been hit hard. Donald Trump's doing his best to try and drive it down. That's one part of him keeping a lid on inflation. I just think it's going to be an interesting story. I mean, look, we've been selling off for a while now, and the question mark here is, do people suddenly start to turn around and say, well, economics-wise, things are looking a little bit more positive? Are we going to start thinking if there's sort of a pro-growth story at the back end of the year coming into the fore? Do we see oil starting to sort of take part in that story, and we see the bulls coming back into play? I don't know. What do you think?
Looking at the oil prices, I think for me and Spit, maybe probably to see more bullish prices for oil, and this is backed by the fact that I'm looking at the key factors that I'm looking at is the global supply and also the OPEC plus, whereby we see the OPEC plus is continuing to ease. The production cuts, raising supply up by 2.2 million. I mean, what I'm anticipating to see at the moment, not really high prices for oil, but I'm anticipating to see more sell-off. Also, whatever transpires, because we have not yet stabilized with the Middle East tensions. So, in case we're gonna see maybe probably more the escalation in terms of the Middle East, then it means then we're gonna see oil supply being cut, and therefore demand rising, and therefore that means more higher prices for oil. So I'm looking at it in both ways. Depending on what transpires. I think the other day I was reading an article by the government of Iran saying, looking at, they had passed, these didn't go to the parliament, whereby they are looking at closing several oil refineries, and therefore if that passes through their parliament, then it means that it's gonna disrupt the supply chains, and therefore we might likely to see the prices of oil go up.
Yeah, it'll be an interesting one. I mean, you're right to note the OPEC production sort of move. I think throughout the next few months we might see increased production, maybe not necessarily in the fourth quarter. How that's going to impact it remains to be seen. Of course, that's kind of been telegraphed now. In terms of the sort of demand supply issue, we're talking about this idea of moving into a pro-growth period and whatever, but right now it's speculation. Like, we're not pro-growth right now. Just because we've got these trade deals, they've got tariffs associated with them. That doesn't necessarily mean that all of a sudden everything's going to boom, despite the fact that we're seeing record highs in equity markets. I would say in terms of the Middle East stuff, a lot of it has calmed quite significantly. It wasn't so long ago that we saw those attacks in Iran and suddenly we thought we were going to see a nuclear war on our hands. Well, it's quite the opposite. In actual fact, everything's cooled down quite a lot. So yeah, I don't necessarily see a big spike in this market. I don't see the justification for that. But I do see the possibility when we're coming into Q4 that maybe if the growth numbers are picking up, we're seeing the possibility of oil prices starting to really take shape. If those OPEC production increases stop, then maybe things could shape up quite well from that perspective. In terms of, I think I had the dollar index chart on here, right? This was a story we were talking about earlier, and about is the dollar sell-off over? This is where we are from a sort of wider perspective. You can see the trend is actually a bullish one from a monthly time frame. Let's see how the trend lines shape up. Absolutely perfectly. So this could be the bottom, right? Is that the bottom for the US dollar? I don't know. I wouldn't necessarily want to call it, but at the same time, if a lot of that is associated with the breakdown in trade relations, and then we get that pretty much out the way, that is a significant part of the fear that eases. But the flip side to it is if at the back end of the year we start to see the Federal Reserve cutting rates, and we see the likes of the ECB and the Bank of Canada doing the opposite and actually freezing rates, then maybe you see that the extension of the weakness story coming back into play. So, yeah, I don't know. I don't want to call it right now, but certainly some of the justification for the weakness of the US dollar is starting to go away with this trade war, not necessarily ending, but certainly reaching a conclusion for some of these countries that appears to be more beneficial.
Yeah, I think for me, I'm anticipating to see more weaker dollar. Looking at it, maybe probably from a stance of the Fed easing, in case you're going to witness the Fed easing. Also looking at it in terms of we have a twin deficit between physical and trade, and we see the US running record high budget deficit at a larger trade deficit, and therefore over time these imbalances might put downward pressure on the dollar, especially if the foreign investors are going to lose their confidence in the US debt sustainability. So also not forgetting about the global de-dollarization trend that is ongoing. So we have seen central banks like China, Russia, Brazil, which are slowly shifting their reserves out of USD into gold, Chinese yuan, and also euro. So yeah. For me, I expect to see quite a weaker dollar still. We are not yet done. It's not off the hook yet.
Yeah. Interesting. And finally, you noted it earlier, the Russell 2000, is it gonna be on a major tear? Where do we stand? I mean, if you're looking at it from, let me just compare it to where the prior peak was. You can see the sort of peak that we saw prior to things selling off ahead of Donald Trump coming into power. You can see it is lagging. The Nasdaq at the top end of the stack here, with the tech names leading the way, the S&P 500 beyond that. Then you've got the Dow definitely being dragged lower by the likes of Apple, and the Russell 2000 hasn't actually managed to regain the prior high. So this could be an interesting one to watch. Like I said, it does well when we see rate cuts coming into the fore. That's not necessarily here at the moment, but might be around the corner. Certainly the Federal Reserve meeting this week will give us some information on that. But the smaller cap companies, people think can boom pretty heavily when they get going. And there's a question mark on whether this is now the time, right? It's a US-centric approach with a lot of money coming into the country, the potential for interest rates to start getting cut. That could be a very good environment for US small caps. To wrap things up, what do you think about that? And are you feeling positive about markets right now, or do you think things are a little bit overstretched considering we're hitting record highs and we still haven't actually seen the full implications in terms of inflationary pressures of the tariffs that are in play and will remain in play with this trade deal?
Yeah, I think to sum it up, especially the Russell 2000, which I'm really looking at, I think we might see some more bullish catalyst, especially the Fed easing. When the Fed easing cycle begins, reacceleration in the US growth, and also whatever we discuss about the rotation from the mega caps to cyclicals. So this is gonna maybe probably see these small caps companies continue to skyrocket, and therefore we see more bullish prices for the Russell 2000. Again, not ignoring the weaker dollar that we are anticipating. Yeah, so in terms of the markets, what I'm looking at majorly in H2, some of the key things that I'll be looking at is the geopolitical tensions again. To see how it's gonna fold out. The Middle East, we have the Russia and Ukraine again, which is on the escalation. It will also be very crucial to look at the US tariffs, the tax impacts as well. The debt sustainability for the US, you are seeing high valuation, and therefore I expect to see volatile H2. And my stance, maybe probably to investors, is to look at ways maybe probably to diversify their investments, and also look at asset, maybe probably to hedge on, like gold, silver, especially for the geopolitical inflation risks. And there are some currencies also which are likely to benefit from the dollar weakness. Again, it's important to really factor that. So I'm optimistic for the markets in H2 as we gear into H2. Already we have started the H2. The first month is almost over. And for me, I'm looking at some mild, should I use, which is the best word that I should use? Looking at a market full of potentials, full of opportunities. So let's position ourselves in terms of what unfolds, and also keeping abreast of what is happening, because again, as an investor, as a trader, whatever guides us is information. So yeah.
Yeah. I mean, look, we're speculating on what could happen, and that's the nature of it, right? You don't know what is going to happen down the line. And the warning sign of that is, remember, Brazil are currently facing 50% tariffs, not based on their trade relationship because they have a deficit with the US, but based on the fact that they are essentially going through court with their ex-prime minister, and Donald Trump's his friend, so he doesn't like that. So Donald Trump might throw some curveballs with tariffs that come out of nowhere, because that seems to be his number one tool for getting his way. Just a nod to, you mentioned likes of gold and silver. I thought silver's a really interesting story. You can see this outperformance of silver recently. And certainly if you're looking to play the whole story around rising debt, but also don't necessarily want to be in on a haven at a time where markets are doing particularly well, silver, I think, is pretty well positioned. Of course, industrial metal, so benefits from the pro-growth stance, but also benefits from that flood away from sort of US assets as we see debt on the rise. And like I was just showing quickly there, the Russell 2000 against the NASDAQ, that's the long-term trend you're betting against. So if you're looking for outperformance for the small caps, it doesn't last that long. It can last half a year, something like that, but generally the big caps always win out in the end. That's it for us today. We've run over by 10 minutes, but I hope it's been useful for all of you guys. A hell of a lot to get through. Thanks so much to you, Timothy, and everyone that's been watching it. We'll make sure that it's available for you guys that are watching on StreamYard. I'm sure it will get sent to your emails. Everyone else, if you've been watching on YouTube, it should be available on both the Global Scope Markets YouTube channel and the Kenyan YouTube channel. Other than that, looking ahead to plenty of volatility for the week ahead. 4 Mag 7 names reporting. We've got central bank decisions from the BOJ, the Bank of Canada, and the Federal Reserve. We've got a week that's going to be dominated by US jobs data, culminating in the jobs report on Friday. That's it from me, and we can say your goodbyes, Timothy.
Yeah, so thanks a lot. It has been a pleasure. And as a sign off, yeah, like you said, we anticipate quite a very volatile week. About 164 companies for S&P 500 are releasing their earnings. Again, the NFP around the corner, August 1st. The Fed again, so much cues to look at, especially the Fed cues in terms of maybe probably knowing where the market is going next. So with that, I would say that stay safe. And stay financially literate, of course, so that you are able to make informed decisions.
Definitely. Thanks a lot, guys. Thanks for joining us. Have a good day.
Thank you. Bye.